From the point of view of a foundation, how is what you do different from what we're talking about? How is it the same?
So one of the things that I heard that was particularly concerning, because I think it's true, is when Roger was talking about the fact that expectations for returns over the coming 10 years is probably going to be significantly less. And Larry made the same point. And so there is consensus around the fact that because interest rates are so low, the expectation is that returns may be more modest. And for a foundation, that's death by 1,000 cuts, because we are mandated to give away 5% a year. So unless we can feel pretty confident that we can receive a 5% return, then that is a slow declining of our portfolio. And really, it really puts our grantees at risk, because we'd have less and less to provide for them over time. And so that is a much worse scenario, quite frankly, for us than if we had a big decline. Because if we had a big decline, we reset our payout, and then we'd slowly see it rise back up again. But right now, there's a general expectation that we're going to bleed assets slowly over time. And so pretty concerning for the foundation community.
So, Kim, what are your options? Do you take on more risk? Do you change your liquidity or duration? I mean, what can you do to address that issue?
So that goes back to some more stuff that you guys were talking about earlier, which speaks to the fact that we're looking for more active management. And we're looking for picking, be it sectors or opportunities that we think offer us the opportunity to outperform. Traditionally, foundations and endowments have put a lot of their assets in alternatives. And that has been possible because we are long-term investors. And so we don't have to worry about the short-term nature of the market. We spend much less time thinking about what's going on in the stock market and in the bond market in any one time. And in fact, we can make investments in things that we think are underpriced and just hold them until they realize full value without having to report on quarters, and maybe not even annually sometimes. And so what we mean by the fact that we're long-term is that we don't have to worry about what happens in the short term. We can invest in things that maybe don't actually produce substantial returns in the short term, because we believe that they're going to produce returns in the long run. The problem, because we have a lot less degrees of freedom, because we have so much wrapped up in alternatives, is that there's less ability to rebalance and to take advantage of things that happen in the short run. We just sort of have to set a asset allocation and stick with it.
Roger, how does that work for you? Because I think TIAA is big in alternatives, aren't you?
We're very big in alternatives. I think we're big in alternatives for maybe some of the reasons that Kim talked about, which is we're thinking about payouts over the next 10, 20, 30 years because we're a retirement-oriented company. And so I think both of us share in common this notion that you want an investment that is going to, some of it short-term, but some of it's going to be long-term. Which leads to a question. I think the thing we have in common is this notion of not needing immediate liquidity. And you should talk about maybe how do you think about liquidity, your liquidity needs, how you project that, and how that drives your investment thesis and activities.
So liquidity is amazingly important for us because we have no inflows of capital. And so because of that, we have to plan for it. Now, we are equity biased. 85% of the portfolio is invested in some form of equities or equity-like securities, with very little in fixed income securities. The issue being that we make sure that we have sufficient liquidity to pay our payout, 5% a year, plus the cost of running the office, plus the cost of rebalancing and meeting our other liabilities, which is a significant number of unfunded commitments as a result of having so much in alternatives. And what we think of that as ballast for the portfolio becomes under normal circumstances, when the market doesn't behave particularly well, and the Fed wants to stimulate, they lower interest rates, makes people go out and spend more money, and makes bond prices go up. We sell the bonds, we reinvest in equities. That's how we rebalance. Now we are concerned about the fact that people will not actually go out and spend because they feel like they have to save more because interest rates are so low, and rates are so low that it will not have as big an impact. And so our fixed income portfolio doesn't have as much ballast as it used to have. And so that's a big concern. And there are a number of things like that which we have traditionally relied on in order for us to portfolio construct for the long term, which are not as dependable as they used to be. And so we're concerned about what that means and how we should think about things differently.
I'd love to be wrong, but I think you guys are way optimistic for the next decade on alternatives. It used to be that there were only a limited number of alternatives trying to pick stocks, and there were all kinds of households making bad trades, and the alternative managers could make money therefore. Now there's much less so-called noise trading and many, many more alternative managers, and they're still all charging high fees.
Yeah.
Used to be you could give up liquidity and make private equity investments and expect to get paid for the fact that you'd given up liquidity. Now there's trillions of dollars in private equity investments, and there aren't that many more deals, so they're being bid up in price. Are you really confident that by turning to alternatives, you're going to generate substantial outperformance relative to stocks and bonds going forward in the way that's admittedly been true in the past? I wonder if the game isn't losing some of its edge.
I hope you're wrong too, but I do agree with you. I do think the game has changed, and I do think that what we've traditionally done is invest in alternatives because we believe that we can create value out of the noise. And you're absolutely right that there's far less inefficiency than there used to be. There's so much capital flowing into the market. There's so many different types of people sort of leveraging all the different opportunities we saw. One of the advantages that Carnegie has, which unfortunately Roger doesn't have, is the fact that we're small. We're only $3.5 billion. We can play in spaces that are niche spaces that capital can't flow in. It's not worth it for some of the larger managers to go into a market that's only can support a $100 million fund or a $75 million fund. But we can play in that market. And so what we're doing is we're tending to go smaller. We're tending to go even more inefficient. It's a different risk profile. So we need to think about it differently. And we know that we are taking on more illiquidity risks because we're going into these markets which do not have the same level of liquidity.
We do have to remember here that when you go to alternatives, you're usually paying 1%, 2% in fees, and then you're paying
I think that's going to have to change.
20% returns, and until you get those fees down, they don't just have to outperform, they've got to outperform a lot to outperform on an after-tax fee basis, because nowadays, as you know, you can get into index funds and pay zero, nothing at all.
Absolutely.
And so I'm just not sure that for the general investor, alternatives are going to be as good going forward as they have been in the past.
If we're looking for markets where there may not be the efficiency that Larry just described, what about emerging markets? There are emerging markets where there isn't as much transparency, there isn't as much efficiency. There's risk, but is that an opportunity?
It is an opportunity, but it is a challenging markets to play in because what you need in those environments are good management teams. You need people who are good investors. You need aligned investments, people who think in a similar way about the relationship between their investors and the markets and how they do things, and that's a hard thing to find. People have very different incentives, and quite honestly, when you're talking about emerging markets, at this point you're talking about China. China's 50% of the emerging markets benchmark, and that is one of the areas that we have to really start to think about how markets are changing, because we've relied on the fact that emerging markets could be differentiators, and we've just said that we're going to invest in emerging markets, and that's going to be a form of diversification, increasingly seeing that the world is not dividing evenly between developed markets and emerging markets, and there may be other ways we should look at it. And possibly China is a form of diversification. There's very likely to be a decoupling between the United States and China because they are going to make very different decisions about technology. And there are countries who are going to line up behind China, and then there are companies and countries that are going to line up behind the United States. And I don't really know who the winner is going to be. And we're going to have to decide how we're going to participate in those markets and provide us with some opportunities. But there are clearly a lot of risks there. It's especially risks when, we're concerned about what's going on there, and we're concerned about the laws and the regulations and how they'll change in response to things that we do here. And it is an inordinate amount of risk, but it is a big market. It's hard to ignore it.
One of the things looking back in the last decade is the tide has risen pretty well with China. Looking forward to the next decade, how far is that tide going to keep going?
Well, they are slowing, but even though they're still slowing, they're still growing a lot faster than we are. And if you're looking for growth, you need to go there. I also think that it's not insignificant that it is a government that can control a lot of things, and it can turn on a dime in many respects. And so it can make adjustments in ways that are arguably more challenging for us to make adjustments.
Roger, how big an opportunity is China in the next decade?
Look, I think broadly speaking, you're right. It is growing. It is still emerging. I think the challenges have to do with transparency, the ability to, get your money out, depending on how you invest, and your very good point around, having teams who really understand what's going on. So I think it is absolutely still a class that one has to look at, but I'm a little more cautious, maybe, for those reasons.
Yeah, no, and I agree with you.
Chinese economy and the Chinese market are very different things.
Yeah.
A large part of the market cap of the Chinese market is state enterprises. I'm not sure that's where I'd want to be betting with my money. You got a lot of arbitrariness in the rules. I suspect you're going to have a bit of a general reluctance to see Americans and American institutions making large amounts of money and taking it out of China. I'm not sure it's going to be so easy to find Chinese managers who could be completely trusted by American sources of funds, given the political environment in China. You can't ignore it, but I think it's be very easy. Hundreds of years of history of optimistic Americans seeing China as a frontier and not having their hopes realized in terms of financial returns.
I think Larry said it very, very well. Could I ask a question here, Kim? So what other big themes are you thinking about? I know there are a lot of investors who are thinking about urbanization as a theme, or the aging population as a theme, AI as a theme. Are there any themes that you think might be a good place for you to play, given that you've got to think about long-term investment returns?
So we have actually, as an institution, study all of those things, and we do research in all of them. So we've had presentations on the future of work and how that's going to change, what sort of skills will be needed. We bring in different peoples talking about demographics and how they are different in different environments. We've spent a lot of time talking about how city structures are going to change and what sort of opportunities. It brings us back often to the limitations of that, because there's a lot of natural resources that are needed to support some of these changes that are happening. These natural resources sit in geographies that maybe are not that easy for us to access, that may be challenging over time. And so that's sort of a break on how fast this progress can happen. Not to go back to China, but for sure, China recognizes that and are going out in search of control over a lot of those assets. And so it's a point of concern for us as we think about those opportunities. But yeah, we have to spend a lot of time on it. And demographics is for sure one of the biggest things we talk about. And it really influences how we think about agriculture and food, how we think about retirement. Hugely concerned about retirement savings and what that means. The pressure that puts on interest rates, quite frankly.